Hi everybody, welcome to our first of two videos on the statement of cash flows. In this video, we are going to tackle the first four learning objectives and just sort of get the lay of the land about the purpose of cash flows, the categories that are used to structure the statement, see how the statement's laid out, and then prepare one from beginning to end using the indirect method. So grab your notebook, get ready, and let's get started. So what is a statement of cash flows? What do we do with it? Basically, the statement of the cash flows is the fourth and final statement that a company is going to use after income statement, statement of owner's equity, balance sheet. We create it last because it utilizes information from the balance sheet and it helps us answer two really important questions. First, what are the sources of cash? What's inflowing into the business and where does that cash come from? And second, where does all that cash go? How is the business using it and where does it outflow to? And that's really going to teach us something about the quality of a company's net income, right? Where and how is it being utilized? And that's going to teach us some things that we can't figure out just from a statement of revenues and expenses by itself. The most important thing to think about here is that we're talking about actual cash. So the money, the change, the dollars, the checks coming in and out of a bank account. So it does differentiate and teach us something different than the more involved revenues and expenses. There are two ways that we can create a statement of cash flows, the indirect method and the direct method. Most of the time, companies are using the indirect method. This method reconciles or compares out our net income to cash by taking from our net income number everything that is non-cash and adjusting for any changes in our current assets and our liabilities. So this is the most appropriate and GAAP approved way to manage a statement of cash flows when you're using the accrual method. So that is the one we're going to focus on. There is a direct method which just lists direct net cash flows from revenue and expenses, and that would be appropriate for a cash basis accounting system, but is not GAAP approved because GAAP prefers accrual accounting. So while our appendix has the direct method, we're going to focus primarily on the indirect method. Both statements using the indirect method and the direct method have the same three categorizations and are laid out in the same order. They begin with a statement of cash flows in and out from operating activities, followed by cash flows from investing activities, and then cash flows from financing activities. Both forms will end with a statement of overall net cash flow, and the numbers will be the same overall. What differs in this setup is the way that the cash flows from operating activities section is created and laid out. Investing and financing sections are actually the same for both models. So this will be the main difference between indirect and direct models. And so we'll focus first on that operating activities section for the indirect model. When you prepare the statement of cash flows, just like the creation of an income statement, a statement of owner's equity, and a balance sheet, it is really important to follow the same format every time and then just adjust the detailed information of that format to suit the company that you're working with or the problem that you're being presented with in our homework or in our chapters. The 5 steps that we're going to follow are to create first the operating activities section, then the investing activities section, then the financing activities section. So we will always work through in that order. Then at the bottom beneath those 3 sections, we will reconcile our net cash flows that we get from those 3 sections to the changing cash balance that we get from our balance sheet. And then at the bottom, we will provide any additional notes related to non-cash investing and our financing transactions. These are the steps we're about to go through in detail. So for now, you just want to get that format organized and into your notes. In order to prepare your statement of cash flows, you're going to need a consolidated balance sheet and an income statement. Remember from your AC101 classes that a consolidated balance sheet is a balance sheet that contains information for 2 time periods, either months, quarters, or years. Then we also need an income statement for your most recent time period of the 2 that you are comparing. And now we're going to work through the cash flow statement presented in our chapter for Prosperity Company. Before we can actually create a statement of cash flows, we need to prep our balance sheet. And so here we have Propensity Company's comparative balance sheet. There are 2 time periods, 2017 and 2018. So we have the full year's balance sheet for those 2 years. And when you get your balance sheets, pay close attention to the order of your dates. Remember that sometimes the more recent date comes first, sometimes the older date comes first. And we want to prep this balance sheet with some information that we'll actually use in our cash flow statement. And the way that we prep our balance sheet is to go line by line on the whole balance sheet, all assets and all liabilities and equity, and note the difference in amounts. How much did that particular line item from the balance sheet change from one year to the next? So here it is just a simple subtraction. In the cash account, cash was $24,300 at the end of 2017. 1 year later, at the end of 2018, they had $47,500 in the cash account, an increase of $23,200. Accounts receivable had $26,000 of people owing them money at the end of 2017. They had just $21,500 in accounts receivable at the end of 2018. So that account is lower by $4,500. And we want to do that for every single line in our entire balance sheet. It's pretty easy if you're setting up a spreadsheet. This column is just a current year minus the older year, and it will show you either positive numbers or negative numbers, and the negative numbers are shown here in parentheses. These dollar amounts will be used in our statement of cash flows, and this top amount shown on the cash line, the net change, the $23,200, is going to be important for us because this is the cash our cash flow statement is going to track. Ultimately, we want to know, where did this $23,200 come from and where did it go out to? How did we end up with that increase? After you've prepped your balance sheet, grab your income statement. The income statement needs no prep. We don't have to find any differences between years or time periods. We just need to pull a little bit of information from this statement. So remember, you must have both the prepped balance sheet and the income statement to get you started. The net income is going to serve as the starting point for our cash flow statement in the indirect method. So once you have those statements, you've done your prep on your balance sheet, you're ready to go. Sometimes you might also have additional information about the activity of your business that wasn't on your balance sheet or your income statement. You might need to gather additional information related to the buying and selling of property, plant, and equipment, and how that property, plant, and equipment was paid for. And if you have any dividends or owners' payments and any stock or owner investments that took place during the year. Small companies may not have this information, but if you are working for a company that's buying and selling property, plant, and equipment, or managing investors and dividends, gather this information up as well. I love a good template. I feel like they are a certainty in an uncertain world. And this statement that you're looking at here is where we're going to end up. It also provides us a really nice layout for how every statement of cash flows should look. Now, if you are working in an accounting software like a QuickBooks or our Crunched.io Brooks books that we'll see later on in our semester, this is a report that can be generated automatically. But it's really important to know where the information comes from. So we're going to create one manually. I've also provided folks with a spreadsheet template that you can then just add in and adjust to suit you as you're working through your problems. But every one that you do should look like this. The top lists the name of the company, that it is a statement of cash flows using the indirect method, and the time period that ends the report. Then we have each of our three sections. Operating will go first, and the operating section begins with net income, and then you actually write the word adjustments to that net income. So you actually can put that statement right in, followed by the adjustments that we'll make. And what we have here are some pretty common adjustments that you'll see. And then a net cash flow for that section. The other two sections, much shorter in general. We have our cash flow from investing activities and our cash flow from financing activities with some common items in each one. We'll end with a total cash flow for the business. And you'll notice right there is that cash check that we had said we wanted to be able to confirm. And then we compare that to some of our balance sheet information. This bottom piece right here, the cash balances, comes right off the cash line of your balance sheet. So mostly we're just pulling information from various sources to track where things are coming in and going out. You then may see optionally any non-cash investing and financing activities that a business engaged in. So this bottom piece may not be there if there was no non-cash investing and financing. And so now that we can see what our end goal is, let's begin the process of creating each section and understand where each line of our statement comes from. So we're going to begin with information from the income statement. We always start with our net income. So you just go to your income statement, grab the net income from that most recent year. So our data for propensity is 2017 and 2018. So I'm going to grab that 2018 income statement net income information. Then the purpose in this section is to identify money in and money out from your operating activities, from running your business, right? Buying and selling product. So that means things that are unrelated to buying and selling product and keeping the business going day to day need to be pulled out for being non-cash and not relevant to cash movement in this section. So the first thing we're always going to do is add back in any non-cash expenses. And the three we're looking for are depreciation, amortization, and depletion. Now, depreciation, if you remember from your financial accounting class, shows how we've spread out costs over time, and we don't use depreciation expense as a cash item, right? There's no cash involved with depreciation. We're just showing how our costs get spread out, but there's no real cash. So any depreciation expense that we've taken is not really money that's been pulled out of our account. So whatever depreciation expense we have showing on our income statement, we need to put that dollar amount back in. So we're going to add depreciation back into our statement of cash flows. You would do the same for amortization, which is for your intangible assets, showing that cost getting spread over time, and depletion of any raw material, you run a mining company, for example, materials that you have where you've been taking a depletion expense. So any of those three categories, add back in the expense amounts shown on your income statement. Then we are either going to add or subtract the effect of any gains and losses from long-term asset sales. We're doing this because our long-term assets are explored more deeply in the investing section of the cash flow statement, and because buying and selling equipment is not part of your revenues and expenses in the running of your business, right? If you remember from your financial accounting, we actually put these in the other gains and other losses categories. So we've got to move these and get them out of the operating activities section. So in this item, you need to do the opposite of what is showing on your income statement. So if there was a gain on the sale of plant assets, so you profited from selling that equipment, you need to subtract that cash back out. And that's what happened for Propensity Company. If you lost money in the disposal or sale of property, plant, and equipment, you want to add that money back in. So any gains of long-term asset disposal get subtracted. Any losses from long-term asset disposal get added in. And these should always be your first lines of your cash flow statement. Now we're going to build the rest of our adjustments using our balance sheet information. And specifically, we're going to use the change column that we created in our balance sheet prep. So after you've dealt with depreciation and any gains or losses on your sale of plant assets, you're going to go to your balance sheet and you're going to list out all of your current assets and your current liabilities. So here we have accounts receivable, prepaid insurance, and inventory as our current assets, and accounts payable and salaries payable as our current liabilities. Now, if you don't remember what categories things go in, remember to revisit your chart of accounts, and I've given you guys that link to the financial accounting textbook so that you can review any information you might be rusty on from your last courses. So we're going to get all those accounts listed. Then we think about the dollar amounts themselves. And this is where it gets interesting. When we're working with our current assets, and we have 3 of them here, we're going to address 2 of them in blue on this slide and then 1 on the next slide. Your current asset amounts need to show the opposite of the change amount. So, for example, if our amount of prepaid insurance increased by $700 on our balance sheet, that means we paid $700 more in prepaid insurance in 2018 compared to 2017. This means if we paid more, that we would have had a cash out of $700. So when the asset increased in our change column, the cash out increased. So we would show the opposite of the asset increase by flipping and subtracting the $700. Same thing for inventory. We bought more inventory, so the asset increased, but we bought it, we show that amount with cash. So our cash decreased in exchange for the inventory increase. And then similarly, a decrease in accounts receivable means that more money came in accounts receivable. So the receivable went down. So if the receivable went down because we had more money, we would do the reverse. So a decrease in receivables in that asset increases the cash into our cash account. So just remember to flip the value, flip the sign on any current asset in your operating section. Then to finish out our operating activities section, we would simply list what's there. So you'll notice accounts payable went down on the balance sheet. We show that in the amount as given as a decrease. And our salaries payable went up, so we show that as a positive increase. So after you've flipped the current asset amounts, you don't need to do anything different in your accounts payables. Show them just as they're listed in the change column of your balance sheet. And so now we can put together an entire section. So let's do one quick review of what the operating activities section should look like. We begin with the actual statement header, cash flow from operating activities. Beneath that, we're going to list our net income from our income statement. Then the heading, adjustments to reconcile net income to net cash flow from operating activity. Sometimes you'll just see the word adjustments and leave the rest off. We're going to begin our adjustments with any depreciation, amortization, or depletion expense amounts listed in the expense part of our income statement. Add those back in. Then we're going to manage those other gains and losses, getting them out of this section because this isn't where they belong. So any gains on asset sales will be subtracted. Any losses will be added back in. Then we go to our balance sheet current assets section, beginning, skip over cash, right? Beginning with our accounts receivable. We're going to list the accounts in the current assets section and whether those accounts increased or decreased. We'll have that information because we prepped our change column before we started this process. Any decreases in current assets are going to show as being added back in to this process. Any increases will be shown as subtractions out. And that's because our assets had to be exchanged for something. We're going to show that as cash. Then we're going to go to our liabilities and we're going to grab any of our liabilities section, and however that change happens is what we're going to list in our operating section. When we're done with that, we need to add up all of those differences. So here, the subtotal, 14,400 minus 4,800 plus 4,500 minus 700 minus 2,500 minus 1,800 plus 400 equals $9,500. And that positive number plus my net income gives me a net cash flow from the operating activities section of $13,840. So the interpretation of that here is that even though I had a net income of $43,040 or $4,340, excuse me, there was actually cash movement in and out of my bank account related to operations of $13,840. So now we're going to go to the investing section. This is always the second section, and it's where we are going to look at the long-term assets and the changes to our long-term assets on the balance sheet. Now, we've already prepped our balance sheet, so we're good to go there. And remember that there's no difference in this section between the indirect method and the direct method. So whichever statement you're using, now it's going to have the same information for both methods. So what information will we use in this section? Well, you're going to go to your balance sheet, long-term assets. These might also be called fixed assets or property, plant, and equipment. So in this example, Propensity has land, they have their plant assets, and they have some accumulated depreciation. This is also where we're going to use any extra notes that might exist. So we have a few that we're going to carry with us. Propensity sold land. It had an original cost of $10,000 and they sold it for $14,800 cash. This sale item is called the proceeds. So we'll use that information as we go forward. They also bought a new piece of land for $20,000 and they paid for that with a notes payable. And then they have plant assets of $40,000 cash that they bought. Now, what's important here is that we keep separate our information from the dollar values on the balance sheet, right? You'll notice that these activities got blended in to a whole bunch of other things that this business already had in those accounts. So they might not map up and you might not be able to see each transaction in the summary presentation of your balance sheet. So let's build. First thing we're going to do is write the header, cash flow from investing activities, so we know that it's a new section. Then we're going to list immediately under that any proceeds received from selling equipment. So any funds coming in, we want to list what we sold that for. Right? So the whole amount. In this case, they sold land for $14,800. So take the whole amount that you got from selling any of your property, plant, and equipment. Directly beneath that, we're going to show the costs of anything we purchased with cash. So remember, this is a statement of cash flow. So we want to see cash coming in from selling our fixed assets long term, and we want to see cash going out for any property, plant, and equipment that we purchased. And that's all we're going to list in this section. Proceeds coming in, costs of purchases going out. Add them up, and we'll get to our total. So here, $14,800 proceeds in, cost of the plant assets going out. They spent $25,200 more going out than they brought in. And then if you have any non-cash transactions, so we bought land in exchange for a note payable, we received a shed in exchange for a truck, right? Anything where we've had an exchange but there's no cash, we list that at the bottom in the category non-cash investing and financing activities. So that goes at the bottom, and remember, you may not have that, but anything that you purchased not directly with cash or exchanged or gave away, sold for a non-cash item would be listed under non-cash. And so this is our investing section. And I want to be really clear about net cash flow from investing. We are not talking about making or losing money. This $25,200 is not debt. It just says we had $25,200 more go out in this category than we had come in this category. So we're tracking cash movement. A company can still be profitable. They didn't lose money. They just had more go out than they had come in this category. If you only bought equipment, you would have a negative amount. If you only sold equipment for a profit, you would have a positive amount. If you did both, it just depends on what you bought and what you sold. But they're unrelated things. So please, when you're looking at these, remember what it's for. It is a statement of the movement of cash. It is not a statement about whether or not the company is making or losing money. So let's reinforce this a little bit. Assume that your bakery makes gourmet cupcakes and has been operating out of rented facilities in the past. You owned a piece of land that you'd planned to someday use to build a storefront. This year, the company decides to sell that land and buy a building. So we buy the building for $85,000. They also collected some interest on investment assets, and there was a gain on the sale of the land. And they told us that the original cost of our land was $22,000. And so what are the cash flows related to these transactions? A couple of pieces of info here as we think about the investing section. First, we would show the purchase of this building, if we bought it with cash, right, as a cash outflow of $85,000. So negative $85,000 or $85,000 in parentheses. This section does not include interest on investment assets, so we would ignore that piece of information. Accounting is fabulous at giving us more info than we need. So just because you're given something doesn't mean you use it. And we would list the full proceeds on this sale, $25,200, in the investing section. And then we'll manage these other items as we move through our process. And so now we're into the third and final section of our cash flow statement. We're going to be looking at the financing section. This section stays the same for both the indirect and the direct approach, and it uses our long-term liability and equities sections of the balance sheet. So by the time we're done with our process, we have considered our entire consolidated balance sheet and pulled the non-cash information from our income statement. So we know we've been really comprehensive. And so here we see propensities information that we'll use for this section. Now, in an ideal world, these would have been labeled more clearly to distinguish our long-term liabilities from our short-term liabilities. That's where headings and documentation really help you out. But we've identified our long-term notes payable and all of our equity accounts from the balance sheet. We also have our information related to the land purchase. So there's that non-cash transaction. They told us that they did declare a dividend to shareholders of $440. And if that information wasn't visible, we would get it from our statement of owner's equity. And common stock was issued in exchange for $45,000 cash. Now, again, like the equipment area, if you have stock being bought and sold frequently, that may be obscured. So you're going to really rely on your notes to get the accurate information. Don't just rely on those totals columns. So we're going to begin our section with our long-term liabilities. And in our long-term liabilities, we saw our notes payable go up. So if our note payable went up, that means we owe more on a note, which means they must have given us more funding. So we show it with a flip because we need to get that additional item back out. So similar to when we worked with our current assets in the long-term liability, we want to flip the amount. So any increase in notes payable is shown as a decrease. Any decrease in notes payable, show it as an increase. Then we list our common stock issuance from the notes they gave us. We show the payment of dividends. Remember, dividends are payment cash out. So we show that from our notes that they gave us. And again, that same land acquisition is listed. You do not need to write it twice. We just note that it was there. And so here is our financing section, clearly labeled cash flow from financing activities. We indicate our notes payable change, our common stock, and our dividends. Add those together, and we had a change in cash flow of $34,560 in this section. So now we're ready to wrap up and check our work. Let's recap what we did. We began with our operating activities section, started with the net income, made the appropriate adjustments, added those adjustments up, and added that amount to our net income to get our cash flow for the operating activities of Propensity. Then we calculated our investing activities with proceeds in from long-term property, plant, and equipment sales and purchases cash out in this category. Added those up and got our amount for the investing section, net cash flow. And then we looked at our long-term liabilities and equity, added those up, and got our financing section. Now we take those three items, the three net cashes, and we're going to add them up. Right? And when you add a negative number, that's a subtraction, right? So 13,840 minus $25,200 or plus a negative $25,200 plus $34,560, and we should get $23,200, which is the amount in our change column from our balance sheet prep. So that's how you can self-check to know that every penny of your cash change has been appropriately documented. So then we add the older year cash balance right off of the balance sheet, and we should end up with the 2018 cash account number. And we're finished. We've shown where each dollar in came from and the coming and going in and out of our cash account for the year. We've also then at the bottom listed that non-cash major transaction so that we can document this large scale asset for liability exchange that took place in the year that didn't involve cash. And that's it. I hope that you've enjoyed this walkthrough. I hope it helps solidify some things for you. Please check out the practice problems in our module. Check your solutions. Reach out to each other. Reach out to me if you have any questions. And I will see you next time. Thanks and have a great day. Bye-bye.